Oh, aloha, everyone. Joshua Hayes at BigWaveTrading.com. I can't remember when I made that last public video lesson, if it was last week or the week before, but either way, I've been speaking about this for those 2 weeks, for 2 straight weeks at BigWaveTrading.com, and every video lesson and every watch list. I've been talking about this negative price and volume relationship. V ramp higher on the SPY, below average decreasing volume on the SPY with the 50-day volume moving average falling. I've told everybody, price is all that pays. Price is all that matters. I follow price. But there are times when I trust price and there are times when I do not trust price. We spoke of multiple negative divergences on all sorts of various momentum trend oscillators from, for instance, I guess this is the easiest chart to look at. So back here in February to March, this is when the negative divergences started for me. IWM was hitting new highs here. All my internal indicators and oscillators that I follow were not confirming. Some of the metrics like volume, up-down volume, advanced decline lines, they were following. But a lot of the internals were not, including some of my scans. I have certain scans that look for strong stocks. More stocks than ever started to Richter in this scan during this period here, December to February. When we made the new highs here in March, that scan actually had less stocks in it than it did back here. Nothing has changed since then. Once again, it was showing up, but the most recent price acceleration with that below average volume, I did not like that profile on any of the indices, none of them. I complained about it the entire time. Respected price, still taking long trades, but there are times when I'm really aggressive with new long signals. There are times when I get quote, quote, great signals, which I plan on doing a video lesson on to showing everybody the signals that showed up in 2020 through 2021. I will increase size. I never got super aggressive because there are also certain internals that I need to line up before I get really aggressive to every new long position. And I'm willing to put for my end of day account balance, if let's say I'm 60% long and I have 40% cash available, if a great signal comes, I'm willing to go all in with that remaining 40% into a great signal. But I need a few things to line up. One of them is I need the monthly time segment volume of the IWM and SPY to be bullish. By the time that happened during the uptrend off the 2020 lows, it was like August and September, well off the lows. And then on top of that, the VIX needs to be below 20, and that didn't happen till March. And what's so funny about that is that's about whenever the market really quit moving higher. SPY went a little bit higher, so did the DIA. But as you can see, the IWM didn't make any headway since. Following a VIX being back below 20 and the monthly TSV being bullish, we should have seen this market explode higher. But how can it do that when it's already made a huge move off the low? And I'll show you how big of a move it's made right now. Tricky to look at, but just pay attention to the white lines and these Fibonacci retracement numbers. From our highs pre-COVID to the lows in COVID, we have made a 162 extension move that happens to coincide with the third ATR. That happened, the last time that happened, let's erase it. We're on the monthly. We're going to do Fibonacci retracements from this high to this low. The last time that happened was back in 2015. We hit the 162 and we were at the upper end of the 3 ATR line in the SPY. We didn't crash, we sold off, but we didn't make any new highs for a little over almost 2 years. It took almost 2 years before we made new highs. I'm not saying this is going to happen again, but what I'm saying is that a lot of moves terminate at that 162 retracement line in the indices that then line up with the 3 ATR. When the 162 and 3 ATR on the monthly line up, that's a sign to me to be cautious short term. Doesn't mean that it's all over, but it is important to be aware. Price volume profile, I kept saying in the video lessons, price is what I listen to. Modulate position size, no big new long positions. More new longs have failed than worked. Yes, you're going to lose in the stock market. Surprise, shocking. But what you got to do is you got to contain those losses, only risk the dollar amount you're okay losing at your max drawdown. That's got to be max. So I always trade via like 1R at risk, 0.5R at risk, 4R at risk, 5R at risk. And I always plan on cutting losses as fast as possible if the stock doesn't work higher immediately. Now, before this move here, we were still taking long positions because they were working. The past week, basically everything has failed. Not everything, but basically everything has failed. There hasn't been too many new long positions. But what I kept saying is, it will not surprise me once again if with this V-shaped rally on the lower volume, if we don't erase all of the gains in 2, 3, 4 days. Well, in 1, 2, 3 days, we erased weeks of gains. Just like here, 1, 2, 3 days erased weeks of gains. So this is why price and volume profile is so important, especially with the negative divergences. So careful here short term. The most important thing that I really want to talk about this current sell-off is that Friday was options expiration. Some of the weakest trading days historically going back to 1950 are the days before options expiration, but most importantly, the day after options expiration is one of the weakest trading sessions historically, seasonally, for the stock market going back to 1950. That happens to coincide right with Friday's sell-off. So Monday could be an ugly Monday. On top of that, in case you guys watching this video did not know, June 18th through June 27th is one of the weakest, I'd say, trading time, rolling 10 days in the stock market. It's not the weakest, but it's in the top 5. From June 18th to June 27th in the S&P 500 since 1950, if you only went long during that time frame, your annualized return is negative 25.5%. And on Friday, you can see what we did. That's day 1. We have until the 27th. Now, the good news is the 28th, the 29th, and the 30th, you have an annualized return of 31.6% since 1950. But coming up during this next week, negative 25.5 is what seasonally normally happens during this week of trading. So if you're thinking about calling a bottom here, I really suggest you hold off on that until we get past this upcoming trading week. Quick, let's run through some of these majors besides the SPY. SPY rolling over on heavy volume. IWM failed to get back above this resistance. This was the most important resistance level for me because that was the February highs. Broke back below that level, and this uptrend line is an uptrend neckline of a potential left shoulder, head, 2 right shoulders. Well, this is now the right shoulder. So I have a head and shoulders pattern. We're now breaking below the neckline on heavy volume. Not good, right? IWM, SPY, not bad. The QQQ, man, I'm going to tell you guys, bifurcation is never good. This is the most bifurcated market I have seen since 1999 to 2000. That time period was way more speculative than now. Even though we have our AMCs, there's not 100 AMCs. So it was more speculative then, more problematic then. But bifurcation is never good. But with the QQQ breaking out on Thursday, how do you know you have a good breakout? You get immediate follow through. Did we get immediate follow through on Friday? No, we did not. Did we fail that breakout? No, we did not. So the weight of the evidence is still on the side of the bulls, but bifurcation is never good. And when the IWM, SPY, and DIA looks like that, tell you what, you're going to only want to focus on QQQ stocks. Now, in case you didn't know, the month of June and July, what is one of the most bullish industry groups seasonally since 1950 for the month of June and July? Healthcare. Look at how healthcare is performing. Look at how the biotech index is performing. XBI, IBB. Now listen, they've had a weak moment in time running into this, but June and July, compare that to the DIA. Compare the DIA to the XLV. Compare the XLV to the XLF. Compare the XLF to the XLB. Look at the XLI. Look at the IYT. Look at all those and compare that to the healthcare sector. If you were thinking of going long this market, fighting the trend of the tape, what sector do you think you should be focused on here? That's the power of seasonality, guys. And July is actually more bullish for healthcare stocks in June. So keep that in mind moving forward. What I'm going to look at before we take a longer term view of the market again is the VIX. Now remember, I told you guys, when my monthly time segment volume is bullish and the VIX is below 20, I get great or near great, and I've reviewed those in past video lessons. Go watch some of the public video lessons I've made. I show you guys what a really good signal looks like. But even then, if the VIX is below 20 and the monthly TSV is bullish, and I get really good signals from high-quality stocks in my best highest quality scans, I definitely increase size. When the VIX is above 20, I pull back. So things have been wonky. Things are not lined up. The best time to get long for me is when the time segment volume on the SPY and IWM is uptrending in a bullish manner on the daily, weekly, and monthly. Right now, it's just the monthly. There's only one index that has a bullish weekly setup still, and that's the QQQ. None, even the QQQ on the daily, are bullish. They're all downtrending below their moving average line with the signal line below it. Or is the signal line the moving average line? I always get these confused. But either way, it's not properly lined up. So the time segment volume, that has been my trusty indicator my entire career to get extremely aggressive in the market, along with the VIX below 20, they're not lined up right now. But the market is still uptrending. I'm not bearish. It's still a secular bull market. I'm still long-term bullish, so I'm still willing to take signals. But I modulate. I adjust my size per the signal. Where I might have, let's say, on Apple. Let's use Apple as an example. Let's say I want to get long Apple here. I want to buy when it breaks 132.56. Well, I would never buy this, first off, because before I know I'm completely wrong on this entire setup, I got to risk down to here. Now, the way to do that, I never recommend anyone risk more than 1% of their account capital in the trade. Let's say you buy Apple when it breaks out here, but overnight a nuclear attack happens and the stock gaps down, and it just so happens to barely gap down just below your final stop. The max you're going to lose is 1%. How do you calculate it? You take 132.56, you subtract it by 122.24, you get that total, and you divide it into 1% of your account capital. You get that total, and that's the share size you buy. So if that particular scenario happens, the max you lose is 1%. Now, I'm just randomly using Apple as an example. I'll never go long Apple here. However, in this tape, because the time segment volume has not lined up with the price and volume profile in the market, and the VIX has been really weird and nothing is really doing well, 1R has been about my max loss per trade. I have increased it a little bit per each signal that looks stronger, that has a better reward risk ratio set up. But every time I've done that since February, it hasn't worked. They're failing. Now, they're not big losses because, like I said, I'm only risking 1R, but they're not working. That's a huge red flag to me. That tells me a lot along with everything else we've gone over. And with me knowing that we're in a seasonally bearish upcoming week, am I bearish on the market? No. I'm actually bullish for July, but don't forget, the two seasonally weakest months of the year since 1950 for the stock market are August and September. October is also very weak. So we have the three weakest months of the year coming up. So if the market rallies in July and we don't make much progress or we do it on lower volume, we're running right into some very, very bearish seasonality with August, September, October. Now, if we just chop and consolidate sideways like we did, notice how in August we actually moved up. Easy money is my only guess why we would even fight seasonality then. But September and October played out as they should. Then we got into November, the Q4 sweet spot. And what happened until April? This is the bullish 6 month, the most bullish 6 month periods of the stock market are November to the end of April. Look at that nice steady uptrend. The most bearish 6 months for the stock market is May to November. But last year kind of was an anomaly. So we'll see what happens this year. I would actually love to see the market chop or consolidate sideways here till the end of October, setting us up for an amazing November, December, January, February, March, April with great setups. Don't know if we'll have it, but maybe. But to end this video lesson off, I just want to show everybody why I am bullish still. Longer and intermediate term. So, my one and trusty gauge of a bear market since my career started has been one key measure, the weekly 200 simple moving average. When the SPY cracks the weekly 200-day simple moving average, trades back up to it, and then rolls over, bad things happen. On top of that, the PPO histogram on the monthly, I want you to notice in 2000, it goes bearish on the monthly in 2001, right before the worst of the sell-off happened. So the bearish monthly on the PPO, the bearish monthly on the PPO here, look at what happened in 2008. Look at where we're at the monthly PPO currently. Are we anywhere near the zero line? No. There's no reason at all to be long-term bearish here yet. Could this be the top and eventually we roll over? Sure. But before the real damage occurs, you have time to know that you're in a bad situation. And that happens especially when the PPO goes below zero on the monthly. Then we can really look out below. But you'll even notice in 2020, remember how everybody thought the world was ending or the next bear market was coming? What did the monthly PPO do on the SPY? So there you go. But my most trusty personal indicator of a bear market is that weekly 200 SMA. Let's go back to 2000. When you crack below it, retest it, and roll back over and hit a new low, you're in trouble. And sure enough, we were in trouble into the bottom in 2002 from that moment on. Then you'll notice we're above the 200 simple moving average. We crack it in 2008, come back up, retest it on the underside, then really bad things happen. In 2011, we try to crack the 200, but we never fail it, retest and fail. We continue to go higher. And in 2020, not only did the monthly PPO not confirm, but we cracked the weekly 200 SMA, we reclaim it. There was no test, rollover, and failure below the lows. Now, whenever you're rolling over, if that monthly PPO crosses lower before you hit a new low, you know you're in big trouble. But the really safe bet to know you're in real trouble is after it tops out, rolls over, and you break that recent low below the 200 SMA. Bad things happen. You top out, roll over below the 200 SMA, retest it on the underside, break below that low, bad things happen in the market. Where are we at right now with the 200 SMA on the weekly? Yes, we have to eventually top, but until we actually break below this level, test it to the underside and roll over, I'm not going to be bearish this tape, guys. Same with the monthly PPO. It's not going to happen longer term. So, short term, be safe out there, everyone. It's really rough. You got the TTM trend momentum confirming, and the DIA, the PPO on the daily has even go below the negative line. And even with QQQ moving to new highs, the TTM trend momentum is not confirming. It's going the other way. So short term, safety, but longer term, keep it in perspective. I'm looking to eventually buy the dips, not on the way down, once it looks like they're stabilizing and then rallying higher. So just need to be careful until that happens. So also besides that, I don't know if you guys check out like SPY versus TLT, QQQ versus TLT, J and K versus IEF. But if you look at the ratio charts, a lot of the long-term uptrend lines are breaking, confirming the short-term weakness. So just want to remind everybody, if you like this analysis here, I do this every day throughout the week. And also give out new long positions before I even place the orders on my end. Every day of the week, if they trigger. If there's no signals, there's no signals, and I keep you safe in cash. But we have monthly, quarterly, annual memberships. We give you the most basic package for an inexpensive cost, and the most expensive package that gets you everything with no upsells is one of the most inexpensive quarterly and annual membership prices you're going to find on the internet. I don't understand why I don't have 1 million members of my website, but it is what it is. I don't market and I don't promote. What I do ask, though, if you enjoyed this video, please give me a thumbs up. Please ring that bell. Please subscribe. Please leave a comment. Help me help you. The more you guys engage with me, it helps the YouTube algorithm. It gets these videos out to more people, and it makes me want to make more video lessons for you. Hopefully shorter video lessons, because this one was supposed to be a 10-minute video lesson, and it's 20 minutes. I could talk about the market all day long. But I'm going to wrap it up here. Have a wonderful rest of your weekend, everyone. And for members of Big Wave Trading, I will see you in the chat room on Monday. Stay safe, everyone. Aloha.